Welcome to my channel where I talk about interesting stocks. So if that's content that interests you, then please consider liking this video and subscribing to my channel because I do this all the time. Today, we're going to be talking about something very interesting company. I'm going to name this video something like the best company you've never heard of, or the most powerful company that you've never heard of, or something stupid like that. But the idea is very, very straightforward. Matson Inc., ticker MATX, MATX. Small cap company, less than 5 billion, but has a phenomenal moat around it. And we will discuss why in this video. Anyways, as always, we're going to do a brief overlook of the company, describe what they do, discuss if they have a moat or not. We're going to analyze the financials, the valuation, and the dividend metrics. We're going to discuss some of the risks, and I'm going to give it a grade if I think it's a buy, sell, or a hold. And we're going to conclude with technical analysis, as always. This is not a recommendation to buy or sell a particular security. It is merely my opinion. Please do your own research when considering investments. All right, without further ado, let's get into it. What is Matson? So Matson is a shipping company. Shipping company that has been around for a long, long time. In fact, it was founded in 1882 in Hawaii. Okay, very interesting. That's a key piece of this story. And the company provides shipping services primarily, as well as logistics services. There is something called the Merchant Marine Act of 1920, otherwise known as the Jones Act. This piece of legislation creates a tremendous regulatory moat around companies like Matson. Okay, so it's very, very important when evaluating this company that we understand the Jones Act. Jones Act of 1920. The Jones Act prevents foreign flagged ships from carrying cargo between the contiguous U.S. and certain non-contiguous parts of the U.S., such as Puerto Rico, Hawaii, Alaska, and Guam. Foreign ships inbound with goods cannot stop at any of these four locations, offload goods, load contiguous bound goods, and continue to U.S. contiguous ports. Although ships can offload cargo and proceed to the contiguous U.S. without picking up any additional cargo intended for delivery to another U.S. location. So what does this mean? It means that a ship, we need to better describe what the actual act does, or is, not just what it does. It stipulates that goods transported between U.S. ports must be carried by vessels that are built in the United States, owned by U.S. citizens or U.S.-based companies, crewed by U.S. citizens or permanent residents, and registered or flagged in the United States. So in other words, a ship that is owned by a Chinese company, for example, and is built in Japan or whatever, that ship cannot bring goods from China to Hawaii, offload half of its containers, load more containers, and then go to the port of Long Beach and offload product. Alaska, Guam, all of the Pacific territories and states of the United States. Therefore, this law creates a regulatory moat around companies that currently have market share within that realm. What's important is the initial version of the law set forth in 1920. Again, we know this company has been around since 1882, so it benefited the company at that time. Okay, so what does this company do? This is from an investor presentation at the Stevens 2024 Annual Investment Conference. So, dated November 2024. As of the time of filming, it is January 16th, 2025. Each color here represents a shipping lane that the company is engaged in. Okay. We see here, this is the Hawaii service. This is the China to Long Beach service. We have the Alaska service. We have the Guam, Micronesia, and Okinawa service. And then the South Pacific service here. And then in addition to that, it looks like our browns here, those are the Matson Asia Express and the Alaska Asian Express. Okay. And then we have the red boxes representative of logistics offices. We'll come back to logistics in a moment. Okay. So, what do you notice about this graph? Every single shipping lane is in the Pacific. And then, of course, we have between islands here. Right. So, clearly, this company has a strong market share as it pertains to moving goods that end up somewhere in the United States, moving goods across the Pacific. Specifically, if goods are to be shifted as they make their way across the Pacific with a stop, it is more likely than not that this company is involved. Okay. Another thing I want to highlight here, Hawaii service. 5 U.S. West Coast departures and 3 arrivals in Honolulu per week. Dedicated neighbor island barge service. So their product is incoming to the major port in Honolulu and then is being broken down into smaller barges and disseminated across the islands of Hawaii. This company is very, very critical to the supply chain of Hawaii. Okay. Very, very critical. We list our competitors. This is an actual company. This is a class of ship, I believe, and then a class of mode there. Obviously, that's very, very high level, but you get the idea. There's, if it for businesses that are bringing goods from Long Beach, or excuse me, from here, and you think about why goods would end up on the West Coast ports here before needing to go to Hawaii. Where are they coming from? They're coming from Mexico. They're coming from Canada, potentially, right? They're coming from inside the United States. Or they could be coming from Asia before coming here. Again, for ships to come from Asia, be Asia-based, come to Hawaii, and they need to be completely dedicated on doing so, right? They cannot make their way to another contiguous port of the United States without violating the law of the United States. For those who are very familiar with the Jones Act, please comment below, give your thoughts, give more weight to my comments, help my viewers understand better, okay? Because it's very important. Here's another thing, this China service, right? There's the China Long Beach Express and the Matson Asia Express is what we're referring to here. CLX and MAX. Frequency weekly from Shanghai or Ningbo. I'm not sure if those are in the same location or different locations or just close to each other. Anyways, it's going from Asia to Long Beach. Both of these services are premium services, premium priced services providing an alternative to deferred air freight and other ocean carriers. Dedicated terminal space in Long Beach with off-dock container yard. Okay, we see this here. Feeder services, door-to-door services in coordination with Matson Logistics. CLX is the number one Trans-Pacific service, and MAX is number two. Expedited 10-day transit from Shanghai, exclusive terminal, unrivaled speed, next day cargo availability. How about that? Number one and number two. They have the number one and number two shipping lanes in the Trans-Pacific. Both are coming from China to Long Beach. Okay, think about that for a second. How they're defining number one, I'm not sure. I would guess that it's in dollars spent in volume. They say it's a premium service. They're able to charge more. Why is it premium? Because it's fast, because it's faster. In fact, we see here that the China service elements of demand, economically advantageous compared to air shipping. It may take 5 to 7 days longer than shipping by air, but it's significantly cheaper for not that much more time. High level of service. Okay, we're back. Fast, reliable ocean transit. So these are the fastest shipping lanes. Okay. You can imagine how there's tailwinds here with e-commerce, goods manufactured in China, but sold in the United States. They're more likely than not traveling on this shipping lane. Okay. Unmatched destination services. Super interesting, right? Super interesting. So what are you what if you're contemplating an investment in this, you're investing in freight moving from here to here. That is a good and a bad thing. We'll talk about that later. If they break this down in their numbers, we'll find out. But I would say that that is the primary thing that you are investing in. Shanghai to Long Beach. Here's where it starts to get more interesting, in my opinion. Alaska service. Twice weekly service to Anchorage and Kodiak. For those who haven't been to Alaska, I highly recommend you go there. I've been there multiple times. In fact, Alaska is the reason that I found out about this company in the first place. In my prior life as a acquisitions person at a commercial real estate investment firm, we acquired multiple investments in the Anchorage area. One was in Fairbanks. This company is very integrated into the economy in Alaska, just as it is in Hawaii. Anyways, twice weekly service to Anchorage and Kodiak. Anchorage is the major economic center. Weekly service into Dutch Harbor. Dutch Harbor is, I believe, that's where the if you watch Deadliest Catch, pretty sure Dutch Harbor is where all the boat crews set out from. So it's kind of it's a merchant oriented stop outpost. Here's the interesting part. Matson is the only U.S. container ship operator serving Kodiak and Dutch Harbor. Kodiak and Dutch Harbor. Those aren't big markets, but that does mean that they have a monopoly on Jones Act freight coming from here between these lanes, the mainland, elsewhere in Alaska, right? Now, obviously, along the Alaska service, they have some competition. Air freight rates are very high relative to the cost of goods being shipped. The volume growth tied to, I'm not sure what NB is, if I'm being honest. Volume growth tied to Alaska's economy. So you see here, Alaska service is kind of in this triangle here. In other words, goods could be coming from Asia to Dutch Harbor, could be coming from mainland to Anchorage, Dutch Harbor, whatnot, right? So if you believe that Alaska is a very important place, like I do, geopolitically, this company might appeal to you especially so. This company is obviously very important to the supply chain in a lot of areas that it serves. Here's the thing about shipping companies, and we'll talk about this in a moment. Shipping is highly volatile and it's based on economic cycles. It's very cyclical, right? A lot of shipping companies, freight rates are a spot market. Freight rates are volatile. They're based on supply and demand. This company, though, they're able to charge premiums on on some of their shipping lanes, or in other shipping lanes, they're the only operator. So they are not nearly the commodity that a lot of shippers are. Okay. They have more pricing power. Guam, they have a Guam exclusive service, weekly service to Guam as part of the CLX service. 3 to 5 day ocean transit advantage from US West Coast. They do have this competitor APL, which is another Jones Act shipper, it appears. Okay. Then they have this joint venture. They have 35% of SSA Terminals LLC, the leading US West Coast terminal operator. So they have 35% of the top market share terminal operator on the West Coast. 8 terminal facilities you see here. So that's a terminal at Long Beach, Tacoma, Oakland, and Seattle. SSAT is the best operator on the West Coast. Okay. Then we have the logistics. So that's logistics is freight is off of the boat. I won't attempt to make too much sense, but we see here all of the red boxes. There's an office there. So freight off the boat is logistics, right? Moving from point A to point B. Okay, so what are they doing? Freight forwarding, LCL consolidation. Not sure what LCL is. I should know, but I don't know off the top of my head. Less than a full carload freight forwarding primarily to the Alaska market. So stuff comes off the boat in Alaska, puts it into a car. Transportation brokerage, domestic and international rail intermodal, long haul and regional highway trucking, less than truckload and expedited freight. Okay, they're moving stuff. Warehousing and distribution, they have 1.5 million square feet across 4 buildings. That's not a lot. 4 buildings. Okay, that's 300 something thousand square feet of building. Mix of contract and public warehouses. So they have, additional locations. So these services, with maybe the exception of warehousing and distribution, these are a little bit more commoditized, right? For obvious reasons. Here is the operating income of their logistics service, notably has seen margin expansion over time. This is not gross margin, it's operating income margin, still in the single digits. Before we take a look at the financials, super interesting, right? Does this company have a moat? Absolutely. It has, first off, but with the services, with the shipping lanes that are U.S. flagged, we'll call them Jones Act protected, there is a strong regulatory moat around that. With the lane Shanghai to Long Beach, the CLX, the China Long Beach Express, there is a moat there around their differentiated service, which allows them to charge premium prices. They would not be able to charge premium prices if they did not have a moat. Whatever they've done, they've carved out a moat there. Not to mention that they also have a moat from these tangible assets. Pier A owned and operated by the JV. And then we have the CLX exclusive use terminal. So they either own or have an economic interest in the actual offshore or onshore infrastructure. So does this company have a moat? Absolutely. It is the widest moat company you've probably never heard of, right? Let's take a look at the numbers. So first off, we're going to start here, as we always do. Revenues in the prior decade from 1.7 billion to 3.3 billion. That is almost a double. What stands out? I mean, just visually on the chart, you see here that there is a very, very large bump. 2021 and 2022. What is that? That is the COVID driven supply chain crunch. Shipping prices went bananas. This, as all shipping companies did, benefited. Okay. The revenue has since come back down to trend, but still appears to be on that upward trajectory. Gross profit, similar story. 280 million to 762 million. That is almost 3 times. We see at one point is 1.5 billion. So the fact that revenues went up, but gross profits went up way steeper. Gross profits tripled from 2020 to 2022, whereas revenue did not even double. That gives you an idea of just how strong the supply crunch was. This is part of what caused so much inflation right here. The shipping costs. This company benefit strongly from inflation. The supply shock driven inflation. Okay. Operating income 133 million, 475 million. Same story here. We see it was in the, low billions there. Very strong. 10x'd from 2019 to 2022. But another thing we see is that, again, it was pretty flat, if not going down. COVID happens, and now we're in an uptrend. What's going on? Earnings from continuing operations also looking pretty good. 70 million to 410 million. Here's where things get really interesting. Okay. $141 a share. Okay. If we look at diluted earnings per share, okay, we see here $1.63 in 2014. Earnings per share has been volatile. Okay. Shipping stocks are cyclical. They don't have very good looking financials on average, if we're being honest. So it's a hard industry to get right. This is December 2019, $1.91 a share, all the way to $27 a share. You do the math. What's 27? What's 141 divided by 27? That's like 5.5 times earnings. Let's come back down to earth to 842 in 2023, 1207 in the trailing 12. What did they do with all that cash? Did they pay stupid high dividends? Most shipping companies do, by the way. Look at Zim, Torm, Starbulk. Look at shipping companies, okay? They pay big, big dividends when things are going well. This company didn't, okay? Dividend per share, 66 cents a share to $1.30 a share. Consistent growth. Okay, obviously their payout ratio came way down over time. Let's buy new ships and let's buy back shares. Look at this. Outstanding shares, 43 million. And then boom, they decide within a few years, we're going to buy a lot of shares. In fact, from 43 million to 34 million, 20%. That is significant. Super aggressive share buybacks. Let's take a look at the balance sheet. Yeah, we see here for the majority of this time frame, they don't have a lot of cash. Don't know what's going on here. They don't have a lot of cash. And then immediately, boom, they start making all this money. I like how they've retained a lot of that. I do. I really like it. I really like that. Gross property, plant, and equipment. Clearly, they've invested in more terminals, more ships, but not aggressively. Other long-term assets. Interesting. Here's another thing they did. They paid down a lot of their debt. In fact, they had $910 million in 2019. Today, $360 million. Looking pretty good. Think about that. 2019, $910 million of debt versus $21 million of cash. The most recent report, $360 million of debt versus $270 million of cash. The balance sheet is substantially better than it used to look. Substantially better. This company is feeling great about their long-term prospects. We see this here. Just the amount of retained earnings. They did not distribute a bunch of earnings back to shareholders, opting instead to buy back a bunch of their stock, pay down their debt, and modestly invest in new capacity. Not enough to tank their pricing. Looks really good. One thing I wanted to highlight here, consolidated operating income and EBITDA. So again, from 2019, if you just remove the aberration of these 2 years here, looks like a pretty steady uptrend, net income and diluted earnings per share. These financials, I'm going to look at a different shipping stock for a second. Zim provides container shipping and related services in Israel and internationally, provides door-to-door and port-to-port transportation. Also provides Zim Monitor, premium reefer cargo tracking service, reefer meaning refrigerated. Okay. Is this a comparable stock? Not necessarily, but I want to just highlight a few things. What do we see in revenues? Same story. Gross profit, same story. Except look at this. Their shares went up. Their shares went up. What else? What else did they do? Look at these fat dividends. They're $16.95 a share. Look at how much their stock price is. Now they still have retained cash. They paid off a lot of their debt as well. Shares went up. Okay. I don't mean to bag on Zim. Okay. It was the first stock that came to mind. In fact, honestly, looking at those financials didn't really drive home the point that I wanted to. The point I'm trying to make is that this company, in terms of shipping, is a volatile industry. We see that there was some sort of beta there. The COVID supply crunch generated a ton of revenue growth, profit growth, a ton of excess cash in shipping. Shipping companies right now have more cash than they've ever had, at least in recent history. This company, Matson, did appear to make really smart decisions with their capital allocation. The thing that I like the most about this company and what they've done is the fact that they didn't aggressively raise their dividend. Again, Zim, basically, they're trading at a price now lower than the total amount of dividends they paid out in 2 years. Okay. Obviously, if you were a shareholder before that time, you're playing with house money now. I really like the capital allocation of this company. We've seen here has had very, very modest dividend growth. And yes, they did increase the dividend substantially, but then just kind of reverted back to the trend. The yield is substantially lower today than it used to be. The market really likes what this company has done. They really have noticed in the last few years that this company is not like the other shipping companies. It actually has pricing power. Most shipping companies do not. Okay. So that's what the numbers look like. Honestly, here's the deal. In terms of making some sort of estimation about where the earnings are going, I'm not going to do that. in this video because that would take too much time. However, I urge my viewers to pull up shipping lane pricing. It's not going to be a perfect exercise with well visible data, but I urge you to see if you can find what's driving earnings here. We're not going to get into that. We are going to talk about the valuation. Okay, so here's the deal. We know, just look at the earnings over time. We're about to do fiscal quarter 2024. The consensus estimate projecting a 79% increase year over year. Prior was a slight drop off. Just look at some of these growth numbers. 79, 57, 20% from the prior year drop off, 45% drop off. I think it's easy to see why the company has what looks like a very objectively cheap valuation, 10 times earnings, right? 1.5 times sales. I think what's really relevant for shipping companies is price book ratio. A price book ratio below 1, I think, indicates severe undervaluation. If you don't even look at earnings growth or anything, it's at 184. Seeking Alpha says this is a B. 1.84 is not bad, but this company was trading below book value at several points within the last few years. Just something to keep in mind. So all the earnings multiples look good. Even if earnings contract, by 50%, you're still looking at a company that's 20 times earnings. And then on a free cash flow, very attractive. Shipping stocks don't trade at high multiples, and they shouldn't. But compared to the sector median, industrials, we shouldn't be comparing to industrials. We should be comparing to marine transportation. So do I find the valuation particularly compelling? Yeah, but not as much as it was. We see here in 2022, again, the company was trading for 2 times earnings. 2018, between 5 and 7 times earnings. The highest it goes up to is about 20. Here we're definitely not the highest we've seen, but we are far above where we have been. Valuation looks objectively very attractive compared to the market average, especially for a company that does have a moat, does have pricing power. It's hard to use a price earnings ratio to value a company like this, just based on how volatile the earnings are. I think we need to look at price book. We see here, this is what I was telling you. At one point in time, it was trading below book value. Still very good, at least compared to history. And what is book value? The value of their cash, the value of their net worth, right? Cash, assets, all that. They have more cash. They paid on debt. They've bought more ships. Looks pretty fair, right? Looks pretty fair. So look, very, very objectively attractive valuation. Not nearly as attractive as it has been. And look, the reason for that is because it's crushed the market in the last 5 years. Crushed the market in the last 10 years by over 100 points. Over time, however, has not fared as well because the stock didn't really do anything for 25 years, 1995 to 2020. Severely underperformed. So all of this outperformance in the last few years has really caught the stock up And in fact, let's look at total return, with dividends reinvested. It's done well. So we see here it is more volatile than the market, has been more volatile than the market. It's a small cap stock. This is a risky investment. It's a volatile stock with volatile earnings, trading at a good valuation. If you're classic value guy and you're like, hey, I don't want to pay 30 times earnings for some overpriced industrial. I want to pay 10 times earnings. I want I want a huge risk premium on over treasuries, multiple point spread over treasuries. I want a safe, and I will say this dividend is very safe, okay? 10% payout ratio. They did grow the dividend aggressively, more than 30% in 3 years, and now we're kind of back on this like pretty normalized trend where they're growing it. They grew at 4 cents a share every year here. Now they're back to, 4 cents here, 6 cents here, 4 cents. So here's the deal. Dividend growth, it's not going to be 9%. This yield is low. Okay. It has a low payout ratio on inflated earnings. Even if earnings come way down, like they're projected to, you still have a low payout ratio. Your dividend here, very, very safe. And I expect this dividend to grow for many, many years. Okay. It's a good dividend stock. It's just the yield that you're getting it at, not great. So why would anybody like this company? Because it's a good idea to have exposure to shipping. If you would have put 100% of your portfolio into shipping in the COVID crash, you would have crushed it. Who anticipated that to happen? There were some smart guys out there that did. It's good to have exposure to some shipping. I think that this is a best in class shipper. Okay. Best in class. Their capital allocation is superior. They have some Modi characteristics. A lot of companies don't. I want shipping in my portfolio. I don't want a lot of shipping. I want shipping in my portfolio. I think this is the best option. Okay. They take a conservative long-term approach. Let's talk about the risks, though. The risks should be very, very obvious. Okay. Look at this. Okay. What stands out? Okay. They are benefiting from this and have benefit from this tailwind of trans-Pacific trade, China to America. Think about that for a second. What's happening? Geopolitical tensions between China and America. Tariffs. Not to mention, again, I'm about to get real dark on you. If there was another war, no doubt would there be a Pacific theater of that war, a world war, right? What does that mean for this stock? Okay. This stock will never trade at a high multiple, and it shouldn't. Okay. If this thing's trading above 20 times earnings, it's too expensive, guys. But here's the idea. If you believe that globalization, there's much longer runway to a globalized world than maybe everybody seems to think, which I do. This should appeal to you. Or maybe you're just a realist and you say, you know what, globalization, that's a shrinking trend. So I don't know. I'm not a fan. Either way, you have exposure to the Trans-Pacific trade just by virtue of purchasing this investment, and it's at a decent valuation. Okay. And then you have this kind of you have like the main shipping lane or the real Modi, China to Long Beach service, but then you also have the domestic service, which is somewhat defensive in that kind of counter um, globalization thesis. So the risks are clear. Okay, geopolitical tensions between the two big dogs in the world. I'm not saying China and the U.S. are equals, but watch Ray Dalio talk about this. China is the challenger. We in the U.S. are the top dog. Okay, there's tension in that, right? Then you have this whole, trade is a huge issue with the Trump administration, the incoming administration, the tariffs, all that. Okay, there's a lot of uncertainty there. I will also say that the heightened geopolitical risks of the last few years have very much benefit shipping stocks. Okay, so don't feel like what's going to happen to them. Okay, I certainly don't feel like I'm that smart. So I like the exposure that this gives me. I'm nervous and excited about the exposure that it creates. So, management wise, operation wise, best in class shipper, certain competitive advantages, but it also is what creates the biggest risks. If you put 100% of your portfolio in this company, don't be surprised when the value of it nukes in a war between China and America. I'm just saying, know what you're buying. Do I grade this as a buy, sell, or a hold? Here's the deal. The stock has performed very well over the last year, 5 years. We've looked. It's been a winner. Even year to date, it's very much outperformed the market. We see here on the election news, the stock bumped more than 20%. The stock just ripped. Since come back down, has began its uptrend again. If the risks here of tariffs and all that are really so clear and a present threat to this stock, then why is it trading like a beneficiary of a Trump regime? Just something to think about. Do I think it's a buy? I do, because again, think about what we're doing here. We're not speculating on shipping rates. I think speculating on shipping rates is frankly a good strategy to make money. You just have to be able to front run it. Are you looking at the shipping rates, and are you looking at the shipping equities, and is there a divergence there? Maybe there's a arbitrage there. I'm not doing that. Okay. I do own this stock, a small amount of it. It's been a good performer. I think there's a lot of uncertainty around it, but I like its market position, and I like, if I'm going to have a shipping stock, I want it to be this. So I think for that alone, it's just best in breed shipping. It's good to have exposure to it. And you're also investing in a continued trans-Pacific trade on this lane. There's a reason they're cheap. Or you could kind of get adjacent exposure to the Chinese economy by something like this, while still realizing good price appreciation, at least in the recent months. So I like this stock for the exposure it creates for the portfolio. I think if you're going to put a big amount of your portfolio in this, I don't know if that's the move, especially not at this price. Maybe when it's sitting there at those just bottom barrel prices like it has been. But objectively, the valuation is good. But that the valuation you're looking at is very volatile. So yes, I do think that it is a buy for what it is, and the fact that it has long term value. But lump summing into this name and leaving it at that, I don't know if that's a good approach. So let's look at the chart. Just want to point out, this stock traded completely flat. This is 1987 here. It didn't go anywhere for 15, 16 years. It performed very poorly. Went down by like 60, 70% here in the global financial crisis from the lows there. Just a volatile stock. But here's the deal. We see it just kind of has been a flat. We know it severely underperformed the market from here to here. Has been crushing it the last few years. So what sticks out? I see there being a clear momentum trade. Really what that looked like was here, right? Each of these candles is a week. So for those sophisticated in technical analysis, you may believe that I am a perpetrator of major chart crimes. I would not dispute you on that. Basically, my approach is draw as many lines that you can recognize as quickly as you can, and draw conclusions from it. It works for me. I don't do sophisticated stuff. The main takeaway is this. Right now, the chart pattern that it's in is this pretty strong uptrend. Every time that it gets close, and these are the 6 and 18 period EMA here, the moving averages. Our 6-day moving average is above our 18-day moving average and has been so really since May of 2023 pretty consistently. The only time we got close to breaking that was right here in April 2024. Continued bullish momentum. Okay. We saw here, this is the election. This is the Trump bump right here, the new Trump bump. Boom. And we just kind of randomly hit a point of resistance here. And we actually broke. I mean, really the right thing to do here is to kind of draw this like this. We kind of broke below this trend line. In fact, we see here our moving average got crossed right there. The chart, I don't want to draw too many conclusions from this one way or another. I think very simply put, you could look at this and say, oh, it's kind of off the trend line. Again, depending on the steepness of this curve, right? Either it's at the trend support or it's breaking below. I think if you were looking to enter a position, I would either say, look, it's in a local low here, let's do it, or wait to see volume tick up and us to return headed back towards all-time highs. I urge you to do your own technical analysis. Tell me what you think, but I don't think it's super bullish one way or the other. I think you can draw many conclusions from the technical analysis. Overall, had a very, very bullish couple years here, and it's been bullish lately. So even though it sold off pretty hard, I wouldn't say that it broke down through that. Okay, that's going to conclude our video. Be sure to like and subscribe if you enjoyed it, and I will talk to you next time. Thank you.